world economy in 2015. Our guest today is John Taylor, Professor of Economics, Stanford University. All central banks today are varying followers of the Taylor Rule, authored by our guest John Taylor. This rule states that an effective monetary policy is one that manipulates short-term interest rates, raising interest rates to cool the economy whenever inflation or output growth becomes excessive, and lowering rates when either one falls too much. A key stipulation of the Taylor Rule is that the nominal interest rate should increase by more than 1 percentage point for each 1% rise in inflation. Many central banks today act approximately as the Taylor Rule prescribes. Thomson Reuters, in fact, lists John Taylor among the citation laureates who are likely future winners of the Nobel Prize in Economics. Good evening, Professor Taylor. Welcome to our show, and it is an honor for us at CNBC TV 18 to have you on our channel. Let me start first with the good news. The latest US GDP number of 5% indicates a fairly robust recovery. Do you think the Fed will hike rates exactly after the promised 2 meetings of no action?
Yes, I think it is. I think it's about time that we move back to a more normal monetary policy, because the interest rate has been zero since the crisis. And we've had a lot of unconventional policies as well. So yes, I think it's about time. In many respects, the recovery so far has been disappointing. It's the slowest recovery we've had from a similar kind of crisis. But now that it's pretty clear that we're effectively at a normal time again, I think it is appropriate for the Fed to begin to make the moves, and I think they will.
Okay, then in that case, Professor Taylor, do you worry that the Fed will be concerned that inflation is not at its target of 2%? In fact, falling commodity prices may actually push the inflation index even lower. Will that stay the Fed's hand?
Well, the inflation rate is just a bit below the 2% target. But again, based on what has worked for monetary policy in the past, with an inflation rate over 1%, 1.5%, say, with the economy getting close to normal, all historical precedent would be that you'd have a positive interest rate, even by now, quite frankly. So that's what the Fed's aware of. They don't want to get behind the curve. With respect to the oil prices, yes, it's a dramatic fall, and that will affect the inflation rate. But these are more temporary effects, and I think monetary policymakers around the world recognize that. And so ultimately the concern is more with the longer term rate of inflation. And if they begin to react too much to these short term effects, it begins to have a negative impact on the economy.
Okay, let me get out of the US situation and come to other countries. You know, you have long argued against quantitative easing, but now Europe looks set to go down that path early next year. Some buying of even government bonds looks imminent over there. Do you think they should go down that path at all?
I have to give some perspective to this. I think the quantitative easing in the U.S. has not worked. Quite frankly, if you go back and look at this recovery, very slow. The first attempt to unwind it last year caused a lot of turbulence in the U.S. and the global economy. The more recent one has been better because it's been more strategic. So overall, this has really not helped, as far as people who've looked at it carefully can tell. But what it has done is affected currency markets. And I think you first saw the reaction to that in Japan with their quantitative easing, and to some extent you've seen the reaction in Europe with theirs. And of course, that's made the dollar stronger, these attempts for the other countries to move to quantitative easing. I think that's been their motive. Ultimately, I think if you went back in history and thought of all the quantitative easing around the world, we would have been better off without it. But we're there now, and Europe is in a situation where they have to deal with the situation as it stands.
Okay, let me put it this way. Do you see a European economic recovery by the end of 2015?
All of this depends on the policy. One of the things I've been emphasizing, actually since before the crisis, is that when we get off track on policy, things don't work so well. You can see that looking at different countries at different periods in time. The U.S., just for example, had an amazing, strong economy in the 80s and 90s, and we got off track and we had this crisis and slow recovery. Hopefully we'll be back on track. Europe's problems go back a little further. Their unemployment rate has been so high, it's distressing. So I think to say that they're going to recover in less than a year is very optimistic. But I think the idea of changing the policies now, again, focusing on these issues which will give stronger growth longer time, it'll help employment, and that's what they should be doing.
Fair enough. Let me get to Japan. Actually, Japan too is all set to embark on another wave of quantitative easing with the return of Shinzo Abe after the elections. But even here, do you see quantitative easing resulting in a recovery in Japan?
I think, once again, the quantitative easing in Japan that began more recently with Abe as he appointed CRUDE to run the Bank of Japan, I think that's best viewed as a response to quantitative easing elsewhere in the world because the yen got very high. And with this new action, the yen is depreciated, and that's thought to be important for the recovery in Japan. I believe it has been. But the other part of this new policy is really the third, what they call the third arrow, and that brings me back to, again, my main concern here is there has not been much progress on these longer-term things that the Japanese economy needs to do. So you do see effects of QE, I think, largely in exchange markets. You're not seeing much effect elsewhere yet. There's lots of turbulence with the tax increase. I think the main impact now, they're going to postpone this tax increase, and I think that's probably a good thing to do in Japan. That'll be a positive.
With dollar being the world's currency, U.S. bonds are bought by all countries with dollar reserves, China, Russia, Japan, India. In a sense, U.S. can have a looser monetary and fiscal policy than other countries. Is that the defining advantage in the United States and helped QE succeed?
Yeah, it is an advantage, no question. There's more demand, but of course that can flip back again. You have to recognize that maybe a time where people say, hey, we're not going to buy so many treasuries, and we need to be aware of that. What can actually appear to be an advantage can be a disadvantage if we become complacent and we say, oh, don't worry, we can just sell our bonds to the rest of the world, and then suddenly they change. In addition, of course, there's debt has to be paid back, interest has to be paid back. So I think in general, it's a false view that it's an advantage. I think ultimately, you've got to think about this globally as well. To the extent that countries borrow or lend too much in other currencies, and as exchange rates move, it can be risky. We're seeing a little bit of that now, I think, with respect to the movements of the dollar. Some countries have said, well, we're now going to have to pay back in these dollars, and that's going to cause them some problems. It could come back and feed back on the whole world economy.
Okay, let me get to other issues. A key trend this year has been the huge rise in the US dollar, especially vis-a-vis the euro and the yen. You know, even Stanley Fischer some time back worried about the dollar strength and said it might postpone the Fed's rate hike decision. Do you think further dollar strength can stimulate US recovery?
I don't think so. I think there's countervailing forces here. The U.S. economy, as I began to say a few minutes ago, does have some momentum. I wouldn't focus on the dollar strength at this point as a negative. I think to me the more serious negatives are just basic kind of policy. What's going to be, is monetary policy going to be too delayed? Is regulatory policy going to continue to intervene more than it should? Those are the concerns that I have. I think at this point, remember the strength of the dollar, the relative weakness of the euro and the yen during the period you're mentioning is undoing or is reversing something that occurred in the other direction where the yen was very strong and the euro was very strong. So you need to put this in a longer term perspective. I don't think it's going to be a negative to the U.S. economy in the near term.
So do you see dollar rising even more in 2015? I mean, given, of course, the weakness in the euro and the yen and their economies, will strong dollar be one key feature of 2015?
Yes, I think you've already seen it, right? That's markets don't just look at the past, they look at the future. And they have been seeing the Fed ending its quantitative easing, at least the purchases of additional securities, increasing the balance sheet. They've seen that diminishing. And simultaneously, they've seen Japan and Europe going in the other direction, or in the case of Europe, at least talking about it. So they look forward. That affects their expectations and affects the currency. And so I think the movements that you've already seen in the currency reflect those changes in policies.
All right. Professor Taylor, on that note, I will have to take a break. But do stay on with us. We have a few more questions for you, more about the East, about China and India. We're back in a minute.